Hello, Dr. Guzak. This is Team Aperture doing our Glo-bus presentation. I am Greg Osborne.
Derek Heckscher.
Phil Olson. And I'm Keith Epperson.
I hope you enjoy our presentation. Our strategic vision for Aperture cameras is to be recognized as the worldwide leader of affordable quality cameras for the amateur and professional photographer. Our slogan says it all: best cameras at the best price. Aperture. We expect reasonable growth in the next 5 years by targeting markets containing customers with quality and price in mind. That's our current strategy, which is a global best price strategy, as opposed to our initial strategy, which was a differentiation strategy. Obviously that didn't work out so well for us, but we do feel that the global best price strategy is the best way to go.
The next part of our presentation involves net revenues. As you can see, we have a positive trend beginning with year 5 and finishing up strongly in year 15. Years 11 and 12 were very positive, as you can see, but they were actually deceptive, as we see on the next slide, where we analyze earnings per share. Here, there's a positive trend in investor expectations, and unfortunately, we only met those investors' expectations in years 11 and 15. As you can see, in very negative years, such as years 9 and 13, unfortunately, we were nowhere near their expectations. This is most likely due to the increased level of cost that we had to face, and production and other costs. The next slide we look at is return on equity. As you can see, there is a consistent investor expectation, and we met that investor expectation or exceeded it on multiple occasions, especially years 7, 11, and 15. Unfortunately, in year 13, we had another negative year with a negative return on equity.
So we can see in our stock price that we never quite hit investors' expectations. Again, years 11 and 12 were fairly close to meeting those expectations, but that was just something we always struggled with in the game. We felt we were a very undervalued company. And then we can see in our credit rating, again, was fairly decent throughout the game, but in years 8, 9, and 10, and 13 and 14, we didn't quite hit expectations. But again, 11 and 12, great years, 15, great year. So as we can see on our image rating, we did fairly well. This was something we always struggled with in our projections, and something we thought made a fair bit of difference in what we did for our employees and how we paid them. That strategy changed just a little bit in the middle part of the game. But again, we did fairly well, and we think we hit our expectations nicely.
For our years 16 and 17 projections, we will be purchasing back a significant amount of stock, and we think that that will positively affect our earnings per share and return on equity. We've set our earnings per share objective at $7. We finished out year 15 with an earnings per share of $6.57. So this really isn't that much of a jump up, but we think it's a pretty attainable target. Also, with return on equity, this target is actually lower than our performance last year. We finished out year 15 with a 32% return on equity. And so we know that that can vary quite a bit depending on the company's performance. So we're setting that at 20%, which is still 5% higher than what the game expects us to do. And also, because we'll be paying down our debt, we believe our credit rating, as well as our performance as a company, will improve our credit rating to an A from an A- in year 16. And our image rating should go up from an 80 due to expanded market share and company performance. And we've set our stock price at $48 a share. This is a jump from about $32 a share, but like I said earlier, we will be purchasing a significant amount of stock back, and that should help strengthen the share price. In year 17, we've put our EPS up to $7.50, and that we believe if our company keeps on the trajectory that it's on, we should attain that. And return on equity, we raised that to 22% because, like I said, we will be purchasing back our stock. And we noticed that Company C, Team Capture, that was something that they had done for almost the entire duration of the simulation. They were consistently repurchasing shares of their company, and it kept their stock price pretty levitated. So our credit rating, we hope to pay all our debt off in year 17, and that will give us a credit rating of an A+. An image rating, we believe that that will go up to 85, and our stock price should go up to $60. That's a 25% increase from year 16, and that's attainable because our company should continue to grow.
Next, I'm going to talk about our entry-level camera strategy. It began as a differentiation strategy. However, we found it difficult to find the correct mix of performance and quality rating and price that was attractive to a sustainable number of customers. Realizing that the entry-level camera market is much more price sensitive than the multi-featured camera market, we shifted strategy to a global best cost strategy. Overcompensating, we priced too low in year 13, but fortunately we rallied in years 14 and 15. We now have what we believe is a winning mix of quality versus price. In years 16 and 17, we expect modest growth in market share and market rises in earnings per share, return on equity, stock price, credit rating, and an eventual turnaround in image rating.
So as we can see, our multifunction camera has always been the saving grace of our company. While our entry-level camera definitely experienced ups and downs, we were able to use the profits gained from the multifunction camera to really buffer any potential losses or downsides to the entry-level camera, especially while we were pursuing market share. In the beginning, we did approach with a differentiation strategy, but we quickly moved to a global best cost strategy in year 10. And as you can see, our pricing, and perhaps more telling, our competition's pricing in the multifunction camera sector allowed us to maintain a generally positive outlook due to the profits earned because of our price and quality ratios. Going into year 16 and 17, we fully expect these strategies in our multifunction camera sectors to continue to experience modest growth.
The next section we're going to discuss will be our production strategy. We have always had high labor costs. We feel that if we initially raised our quarterly PAT or PAT training, our PAT efficiencies might have increased enough to lower the per unit labor costs. Consistently after what we consider kind of the steep learning curve of year 10, where Dr. Guzak stepped in and helped us a little bit, we've strived to reduce labor costs and costs in general by utilizing our overtime over outsourcing. That might not have always been the best strategy in retrospect, since on occasion our outsourcing was actually less expensive than our overtime costs. It was almost a matter of principle, since we had spent so much capital expense purchasing those workstations. And we did add factory capacity at least twice. In retrospect, we probably should have made do with the overtime increases instead. That said, we're now in an excellent position, as continued growth in both camera markets will eventually catch up with the number of workstations that we have purchased. Until then, we just will have to live with the increased overhead costs. In the long run, we'll continue to pay our employees on the high end of the industry standard, because we've, of course, discovered that people capital is one of the most important expenses that a company can spend.
Regarding our finance strategy in years 16 and 17, we are going to have a goal of paying a $3 dividend in year 16 and a $4 dividend in year 17. In year 15, we paid a $2 dividend, and we did that pretty comfortably. So if we continue on this current trajectory, we should have enough money to finance a $3 dividend in year 16 and a $4 dividend in year 17. We have not issued any stock to raise capital. Instead, we took out loans to finance operations when needed. And our current debt payoff at the end of year 15 was 1.4 years. So that's a pretty reasonable debt payoff period, and we hope to have that all paid off by the end of year 17. We plan on purchasing our own stock, buying it back, until our stock price reaches $60 a share, which is our current projection for year 17. Our current credit rating is an A-, and we should have an A by the end of year 16, and we hope to maintain that going into year 17. And also, one thing that's always a big factor when you're talking about your company's finance strategy in a multinational corporation is exchange rate risk. And throughout the course of the game, we realize that exchange rates can really have both a detrimental and a positive effect on your operating margins. And so we'll do our best to look at the exchange rate projections and plan our business accordingly each year.
Now we'll discuss our closest competitors. We consider Capture Incorporated, or Company C, our closest competitor in both the entry-level camera and multi-feature camera markets. They seem to follow the global best price strategy just like we do. Unfortunately, their best in industry status has made them not only a worthy target to emulate, but also kind of difficult to follow, since they've held that pretty much since the beginning of the simulation. However, we do seem to be closing ground on them in most areas. And so how to outcompete our rivals. In the ELC market, we plan on increasing our offerings product quality rating to 3.5 stars while keeping our sales price within the same ballpark as it was in year 15. In the multifunction market, well, that's always been our strongest market. Right there, we hold some of the best market share in every region, and our cameras are nearly identical to Capture. So we mainly attribute this to our advertising outlay, which is quite a bit more than Capture's, and it shows. We plan on increasing the number of models offered in years 16 and 17, which will of course give us an efficiency hit, but we expect to make that up in market share. Lastly, we're going to close out with our lessons learned. I think that one of the things that we learned from Glo-bus, which I think we all consider a pretty good simulation, was that you have to pay your employees well. Dr. Guzak talked with us at the end of year 9 when we were not doing so well, and discussed that by investing in people capital, you'll kind of reap the long-term benefits that might not be obvious from a financial statements only point of view.
The next lesson learned, we learned the hard way, was that you have to charge reasonable prices and avoid that fight to the bottom. Simply lowering prices so you can gain market share but lose money on every camera sold just was not the way to conduct business. And Dr. Guzak was great for pointing that out, because it was the fiercest competition that was driving that goal for everyone to be that low-cost leader in the industry. So that was definitely a big lesson learned.
We also learned that while dividend payments can certainly be beneficial to the company, Dr. Guzak was very helpful in telling us that we couldn't afford it, and that we found out we can only do that when we truly have the funds to support that. Another thing that we learned is that trying to be a mass producer of entry-level cameras, we expanded our plant capacity. And one thing that's important to note when you expand and build a plant for $10 million is that you can't liquidate it in the game. You're not allowed to sell it or get rid of it. And so I think we added about 3 or 4 plants in the game. And so when our production scaled back, we were still bearing a huge administrative overhead burden for those plants that we had overexpanded. And so basically, essentially what I'm trying to say is that if you're going to expand, you need to be 100% sure that you're going to need that plant capacity in the future.
Again, overall, I think the Glo-bus simulation is definitely worthwhile and valuable. We learned a lot, and honestly, I'd kind of like to be able to play it again. So,
Thanks, Dr. Guzak, for viewing our presentation. Give us a good grade.
thank you.